Do you want to know how to pay down your home loan faster? Let's face it, who doesn't want the answer to that question? Well, today we're talking all about how to use debt recycling to pay down your home loan faster, get rid of your bad debt, increase your good debt, and put yourself in a much better financial position. And I've got an expert here today to talk to us about this, Joshua Fileti from Synergy Private Wealth.
Thank you.
Welcome, Joshua.
Thank you. Thanks for having me.
This is the first time we've had a chat on one of our lives, so thanks for joining us today. It's a really interesting topic, I think. And this is obviously, you know, you're a great financial planner. You help a lot of people, a lot of Rise High clients to improve their financial position. And this is a really interesting topic that Joshua and I were talking about in terms of debt recycling. So let's get into it.
Let's go.
Let's go. Before we get into debt recycling, I want to talk about good debt and bad debt.
Yes.
Just so that we can differentiate what those things are, because I really want our viewers to get a good understanding of good debt and bad debt and what the difference is.
Yeah. Perfect. Look forward to it.
Okay, so let's get into it. How would you define good debt versus bad debt?
Okay, so good debt and bad debt. So basically in financial circles, we like to differentiate between the two types of debt. One debt may have some tax deductions attached to it and the other debt doesn't. So typically speaking, we often find that debt that's potentially connected to maybe a home loan or a home, a car, so maybe even a personal loan or a credit card, we would consider or group as being bad debt.
Yeah, so that includes your own occupied mortgage, really, doesn't it?
It does, yes.
Yeah.
Yeah. So anything that we're not getting tax deductions on would typically be grouped in that type of arrangement. Yes.
So if I could just say that in another way, would you say that good debt is really any debt that's for the purpose of an appreciating asset that's tax deductible, that's
Correct.
giving you a passive income?
Spot on.
So that could be an investment property, it could be a share portfolio, something that
yes.
is growing in value and giving you a rent, giving you a passive income.
Correct.
And bad debt's pretty much everything else.
Essentially, yes. So any type of investment, in theory, that generates, yes, some income, can be considered as that good debt, yes.
So I guess the magic goal really is to make sure that we're minimising our bad debt, trying to eliminate all of our bad debt as quickly as we can.
Yes.
But good debt's not so bad, is it?
Well, yes. So the way that we like to look at it, if we can, I guess, reduce that bad debt component and increase that amount of good debt, so debt that we're getting those tax deductions on, what that basically means is we can lower that tax position a little bit, and those savings we can allocate elsewhere. So to increasing our wealth,
increase our cash flow or reinvest them.
Yeah, correct. So
which is better in your pocket than in the taxman's pocket, isn't it?
Look, couldn't agree more. Yes, yes.
Yeah, we've got a few shout outs saying hello to Todd, Nick, Sean, Sarah and Lucy. Thanks for joining us, guys. I really appreciate you being here today, and we are taking questions live today, so if you do have a question, put it in the comment section below. So we've just talked about good debt versus bad debt. So basically the goal is reduce your bad debt, increase your good debt, put you in a better financial position, keep more of your own money and invest more of that money into building your wealth. So that brings us on to the question of debt recycling, which is really what today is all about. And of course, what we're doing today is, you know, general information, but if you're interested in this topic, you should get some specific advice. But let's talk about debt recycling, because this is a really interesting concept, a really interesting strategy that's working really well for a lot of investors to help them pay down their home loan sooner. Yeah. So what is debt recycling, Josh?
Yeah, so debt recycling, just to recap, is basically switching or trying to reduce the bad debts that one might have and increase the amount of good debt or debts that we're getting tax deductions on. So effectively what we like to try and see is as people's situation develops and evolves, their debt that they're getting no tax deductions on reduce, and on the same time building some wealth with some other investments which can help provide a really good lifestyle over the short to medium and long term.
There's probably a bit of a understanding here with how to do that, I think, because we often have clients that come to us and maybe they're currently living in their home and they're wanting to buy a new home to move into, wanting to upgrade into a bigger home, and they're wanting to convert their existing house into investment property. And they often say, well, can I just take out a loan against the equity in this, the property that will be an investment property, for the purpose of purchasing my new home and make that tax deductible? And it's not quite as simple as that, is it? Because, people think that it's the security that will determine whether a debt is good debt or bad debt, but it's actually not the security, it's actually the purpose of the debt.
Yes.
So how do you, with this debt recycling where you're maximising your good debt, minimising your bad debt, how are you doing that without sort of interfering with this purpose rule? There's really a purpose rule, isn't there?
Okay, and look, Marissa, you raised with this, we need to, before we unpackage and start doing anything really serious, I think it's really important that we have a good broker like yourself involved in this. We need an accountant that also knows what they're doing, because if we get this wrong, it can have disastrous consequences for our clients. So we need to be really careful, and what I like to do is first, before we do anything, is set a really, really solid foundation. And that foundation really stems from the financial planner, the broker, and the accountant all being on the same page, singing the same song, and knowing what everyone is doing. And I find by doing that, what that basically means is the security is right, we've got the loan structure correct, and obviously the ATO's on our side as well. We don't have any skeletons in the closet. So I find that's probably the best thing to focus on.
We've had a question come through, which is, how do I do a debt health checkup? So that's probably something that Rise High can help with. So that's really it's a free process. So it's really easy in the sense of just making sure that you book an appointment with your mortgage broker and getting them to review your debt structure and your debt strategy. And with your mortgage broker, you should be able to sit down with them to look at what your current structure is, look at if there's ways to improve it. And if there is a possibility for some debt recycling, that's where we'd bring someone like Joshua into the mix to give you some proper advice about that. But just doing a simple review of like a health review of your debt also enables you to do a bit of a debt management plan where you can actually decide how you're going to manage your debt moving forward and how you're going to prioritise which debts you'll pay off and in which order. So that's a great question. Thanks so much for sending that through. I hope it's answered the question. So getting back to debt recycling, can we just talk about the pros and cons of debt recycling?
Yes, certainly.
What are the reasons why you'd consider it? What are the reasons against it?
Okay. So there's a couple of reasons why we'd consider it. Obviously, we've spoken a bit about the tax benefits. Now, that's not the only reason. I like to also consider it because of diversification. So because we're not just investing, say, in property, we're using that property to unlock some equity, but we can be diversifying in other assets. So they could be some shares, some managed funds, potentially even commercial property. So this really gives us, I guess, really good exposure as far as not putting all our eggs in one basket and splitting it over a couple of different areas. So that's one of the positives. The other one I like to consider is flexibility, right? So a lot of people ask me, Josh, what's this flexibility? What are you talking about? Now, put simply, if we were to say, for instance, purchase an investment property, if something was to happen, we can't just sell a room of the house to help a loved one if they need some financial resources. With these strategies, we use something called liquid investments, investments that can be sold. So if there is an emergency, we can sell some of the assets to just get us out of a jam and then recalibrate and go forward from there. So there's some of the positives that
what about on the flip side, some of the negatives or things to look out for?
Yeah, and good point. So like with any strategy, any investment strategy, there are some considerations that we need to look into. There's probably two big key ones here I take out. The first one is market risk. So this is the risk of investments going up and down. So it's something that we need to be careful of. This is where I come into it, just to make sure.
So would you say because of that risk, you want to make sure that you're looking at this as a long-term,
yes,
a long-term proposal rather than coming in and out. It's really not a get rich quick scheme, is it? It's really a long-term strategy to, over time, reduce your bad debt, increase your good debt,
certainly
build your wealth. But it's not a get rich quick scheme. Let's put that out there.
Yes. Run away from those schemes. But this one here is very much a long-term, 5 to 7 year strategy as a minimum time horizon. A bit like investing in a property, right? It's really looking for the long term, putting in place some good measures straight away and going from there. The other key consideration that we do factor in is interest rate risks. So interest rates rising, how do we factor that in? So they're things that we definitely consider.
And that, of course, can be managed, that risk, because we can look at fixed rates to manage that interest rate risk. So if that's a real concern to the person that's doing it, we can look at a fixed rate strategy to minimise that risk over the short term.
Yeah, certainly. Yes, correct.
So who should really consider this strategy? Like, who is this strategy really good for?
Yeah, great question. This strategy isn't for everyone, so I will put it out there. The reason is because we've just spoken about the risks, so we do need to be careful with who we suggest this to. So typically we like to explore this strategy with people that have good incomes, that have stable jobs. That's important because, again, if something happens, the last thing we want to do is unravel this strategy really, really quickly, because that doesn't end well, potentially.
So would you say also, to add to that, people that have a good emergency fund savings buffer?
Yes.
So that if something did come, we always like to encourage clients to think about having a bit of an emergency fund savings budget, which would a savings buffer, which would see them through maybe 3 to 6 months of, no income.
Yes.
As a family. So if something was to happen, unexpected things happen, unfortunately.
Yes.
You've got a bit of a savings buffer there, an emergency fund that would see you through for that period. Would you say that maybe that would be a good thing for people to have before they consider a strategy like this?
Yeah, so definitely, even if they don't have it, it is something that we would recommend as a contingency.
Maybe if they don't have it, but they've got a lot of equity and good income, it is something that we could build into the debt structure.
That's true, and I have seen that happen as well.
Sometimes if they don't necessarily have that savings buffer up front, it is something that we could build into the debt strategy to give them that provision to make sure that they do have that buffer just in case.
Yeah, well and truly. And there's other things that we also consider too. So people sometimes they might be with an employer for a long period of time. So they might have some annual leave, some sick leave provisions, some long service leave. So we will use these provisions as just as a safety net should something deteriorate really quick. So there are a lot of things that we do consider to try and reduce the risk and keep our clients on track.
Yeah. So apart from good income, good stable employment, good savings buffer, or a fallback plan.
Yes.
What other criteria would you say is important for a person that should consider this strategy of debt recycling?
I guess probably the other key component, we've already touched on this, is the time horizon. So if someone came to me going, look Josh, I've only got a 12-month time horizon, I would shy away from it because the risks associated with it. So really we are looking for that 5, 7, 10-year plan. And I know things change, but ideally that's, I guess, the timeline that we're looking for to try and really right the risk.
Like a 5 to 7 year time frame.
Yes.
Would you say that if people had even longer than that, it's better?
Oh, certainly.
So the longer the better.
Yes, correct.
Really?
Yeah.
And I guess the other criteria that I'm guessing from what you're talking about is that they have to want to build their wealth.
Of course.
They have to have a little bit of a risk appetite in terms of growing their investments and growing their wealth to consider this strategy.
Yes. And also, I guess, be willing to delegate as well, because working with closely with an accountant, a broker and a financial planner, they do need to relinquish a little bit of control because they're getting some input from a professional party. So,
but saying that, all of the decisions will ultimately be theirs.
Of course.
And they'll have full control over what they decide to do.
Yes.
But obviously getting advice from people that can guide them in the right direction.
Yes.
Yeah.
Agreed.
Okay.
Yeah.
So I think we've got some more shout outs to Daniel, Penny, Helen, Ben, Sean. Thanks so much for joining us, guys. Really appreciate you tuning in. We are taking questions live today, so it is a really interesting topic that we haven't covered before. So please send your questions through on the comment section and we'd love to answer them. So how do you actually do it? Like what steps do you actually take to set up a debt recycling strategy? How is it done?
Great question. That's probably the $1 million question, really. Okay, so we've covered off on that we need the professional parties involved, so everyone needs to know what they're doing, so we've got a good foundation. Once we work out how much equity can be unlocked from a property, or
which we can easily get a free valuation for people so they can work that out.
Yes, and you'd be able to do it really quick.
Yeah.
Ideally, we like to try and make sure that we're not incurring any lender's mortgage insurance.
So keeping the lender's mortgage, so the loan to value ratio below 80%.
Yes.
So that means borrowing less than 80% of the value of the property.
Yeah. And once we've got, I guess, those boxes ticked, then the broker will basically explain to us how much we can loan without causing too many issues. A loan is then drawn, which is fine. So that there is up to you and your team here, Marissa, typically. And once that's drawn, that loan, we will use those funds to purchase some investments. Now, the important and key critical thing here is that those investments, the income that they generate, needs to pay off the dirty debt. So that debt that's attached to that home, which doesn't carry the tax deductions.
So basically, you're saying that you're using that money that you've released, the equity release, the money that new money that you've borrowed, which is good debt, tax deductible debt. Any income derived from those investment assets are going towards reducing your home loan.
Yes, that's typically how it works. Yes.
So then what's happening to the interest of the bad debt?
Yeah, and this is where, and great question. So the interest on the bad debt, so basically, and this is where we do the cash flow analytics. So we need to be able to service that. So we may look at an interest only type of structure to keep the interest low, but effectively that interest typically is tax deductible as well.
And do you typically like to see that interest capitalised so that, you know, for that good debt, it's kind of increasing over time whilst the bad debt's reducing at a more rapid rate? Or do you normally like to see the interest paid on that good debt to at least keep it at a same balance? Because I'm thinking if you capitalise the interest on the good debt, then you're actually accelerating the payment.
I understand where you're coming from.
The bad debt.
Typically, the approach that we take, and great point there is, we typically would just have that interest paid off over a period of time.
Yeah.
And then we like to review these strategies maybe every, say, 12 months. As the equity increases, we then draw another loan, which we then use to purchase another pool of investments.
And at the same time, reducing the home loan debt.
Spot on.
Yeah.
So effectively what we do is we keep repeating this process every so often until the bad debt or the home loan debt not connected to any investments is completely repaid, and we're just left with a tax-friendly loan and a big pool of investments.
So in your experience, have you seen this scenario work for people that have been able to pay down their home loan in a 5 to 7 year time frame using this strategy? Look, I guess it depends on so many hypotheticals, but is it possible?
Yeah, it's possible.
Yeah.
However, there's so many variables, you know.
So many variables, yeah.
The size of the loan, the income that they've got, other resources they might have available.
Yeah.
Have I seen it occur? Yes. Would I say it would occur for everyone? Look, it's a case-by-case scenario.
Yeah.
But we can definitely reduce that.
Do you have some live examples that you can share with us just of...
Yeah, of course.
Some recent people that you've helped with this strategy?
Yeah. So what we did, we did one of these strategies with someone recently. So it was a young family. One person was, the mother was staying at home looking after the 2 children, which was good, and the partner was going to work, earning quite a reasonable income. So quite a traditional scenario here. They had noticed quite a lot of appreciation in their property, which was fantastic, and they wanted to grow their wealth, which was good. So we did a whiteboard analysis, really. This is how we worked out what was the right thing for them. And on one side, we compared, okay, if we invest in, say, an investment unit, the stamp duty, the water rates, the strata fees, what would things look like from that perspective versus employing a financial planner, getting some guidance from that financial planner, opening up a pool of investments, what would be some of the key considerations there? Ultimately, the client ended up going with a solution that I had advised for him, or for them, shall I say, because they didn't want to deal so much with tenants, chasing up the rent, this, that and the other. They really wanted to spend a lot of time camping as a family unit. So this solution that we provided for them gave them the opportunity to do that. Get that income, build their wealth, but as a family, focus on the family and not have to worry about the headaches that can potentially come with direct property investment. So that's the
And so how did that help them to reduce their home loan faster?
Yeah, great. So effectively what we're doing now is the investments that we've opened up for them, all the income that's generated from those investments just goes towards paying off that their home loan.
Yeah.
We've set up an interest-only loan on the investment side of it, and we'll just need to review in the next 12 to 18 months and see.
So they've got, as well as their employment income that they had previously, they've now got an investment income also coming in to
Correct.
pay down that home loan debt sooner.
Yeah, and that investment income can be, I guess, if we were to compare it with something else, it's like your rent. So instead of it getting it from one component, we're getting it from somewhere else. That's all it is.
So I guess in summary, this is really a strategy for people that are interested in growing their wealth, want to utilise some equity in their property, and want to have a strategy where they're getting more income so they can pay down their home loan debt and their bad debts, so their car loans, credit cards, etc., faster, and obviously increasing their tax deductible debt. So I think we've pretty much run out of time, but is there any other... we did have a question. How is Josh different from my accountant? So Josh is not an accountant, he's a financial planner.
Yes.
So my understanding is that you work with accountants.
Yes, correct.
Can accountants give, I guess accountants can give advice about, can accountants give advice about debt recycling? I don't know if that's within their licence.
I think an accountant can give advice on the tax benefits connected with it, this type of strategy. The key difference here is the accountant will not be able to purchase the investments on behalf of the client or set up contingencies.
And probably won't be able to give them advice about the type of investments.
Correct.
That would help with the debt recycling strategy. So I guess just to the question is that you probably need to have, like you said, the team, the mortgage broker, the accountant and the financial planner all working together to get this strategy right. You probably do need your accountant involved, but also need to be getting some advice from a financial planner in relation to the investment strategy that supports a debt recycling strategy. So hopefully that answers your question. So I'm going to wrap it up in a minute because we have run out of time, but is there anything else that you wanted to say in summary just in relation to debt recycling?
Look, I guess in summary, it's a fantastic tool as part of a kit bag. So it's not something that I will just ultimately give advice on just one element. I think we need to take into consideration other aspects, but as far as a broader, I guess, wealth creation strategy, it can work fantastically. On the back of that, obviously, we do need to make sure that we've covered off on certain things, reduce the risk where we can, put in place contingencies, but it can definitely help people build wealth, provide them with flexibility and give them options for the future. So
Absolutely.
I think it's great. It's a great option.
And I guess just to wrap it up, I'd also say that it's really important that you get your own specific advice. So you can start with, you can start with us as your mortgage broker, or you can start with Josh from financial planning. So it doesn't really matter where you start. Just start with someone and you'll get the right team to support you to get the right advice that is going to suit your particular situation. As always, thanks for tuning in. We really appreciate you tuning in today. and we'll put our details and Josh's details below so that you can ask any other questions that you have. And of course, we're always here to help. So if this strategy sounds interesting to you, then let us know and we'd love to help see if it's going to work for you and your family. Thanks and have a great day. Bye.
Thank you. Bye-bye.